Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, December 28th, 2020. In this video, we'll take a look at the broad markets. Brief update. There's not a whole lot to report. We're kind of grinding around here for the last few weeks. So we'll talk on, just look at some levels to watch and some developments to watch for. And then I'll hit on some of the other commodities and things that I've talked on lately. Copper. I'll do an update on natural gas. There's been some movement there the last couple of days, and gold, U.S. dollar, and the euro. So that in roughly that order. Let's start with the markets. We had this is the S&P 500 tracking ETF SPY 60-minute chart right here, meaning each candle is 60 minutes of trading, and you had a trend line here that was broken, and it looked pretty impulsive. We gapped down below it. We back tested and back tested for a while, so the trend line was certainly being respected until today. Now we jumped above it, not by a whole lot. So what that does, it makes the trend line, in my opinion, a little less valid, being that now we've traded through it. It was, like I said, it looked like the real deal breakdown, back testing. Now, of course, keep in mind, this is the end of the year. This is the doldrums. A lot of people are on vacation. They're not trading. Volume is very, very low. And so you're going to get whipsaws. It's par for the course, during times like this. And so where do we go from here? All I can tell you is that the last high was a divergent high before that breakdown. We had a sell signal there, on the breakdown. We back tested, but now we're back above it, which effectively negates the sell signal, if you will, or makes this trend line a little less valid. Now, any marginal new high anytime soon will still be a divergent high. We had divergence there. You can see here's our divergence line. Should we go up, it'll still be a divergent high. So here's the thing. I thought we might get some movement by the end of the year, especially with these breakdowns, but we didn't. We don't have any follow through, at least not yet at this point in time. So we'll see what this week brings. A few trading days left in the year. And if we don't have anything big, of course, we'll pick this up after the first of the year. Let's look at let me turn off all the lines here, show you real quick. There's where we're at right now, 371.93 on SPY, and that's effectively where we were back here when I take where the crosshairs are, all the way back on December 8th, right there. So there it is. That's 3 weeks of pretty much going nowhere. We're back to where we started. There's been a little bit of down, a little bit of up, a little bit of down, a little bit of up. We are near the highs. You got to give it that. But for the most part, this is a multi-week sideways trading range right there. We'll see which way it breaks. The only thing I can tell you again in the charts is we have these divergences building, and we have that low volume. When I go back to the my low volume indicators are down below. Here's the SPY. This is the 10-day exponential moving average, the blue line here on the volume of the S&P 500. And I've gone over this recently. I have two lines, a red line and a yellow line, which mark extreme levels. When volume drops down to those extreme levels, it can stay low for a while, but shortly afterwards, that's where your biggest corrections have come from. Even the smaller corrections along the way, there have been corrections. This one was a correction in price, but also in time as well. The market's traded down to sideways for a couple months there. And then, of course, the biggest drop that we had came after the longest, most persistent period of extreme low volume. Again, drops down to those lines. And so since the COVID lows, I call it, back in March, the biggest drop correction that we had was also preceded by drop down to this level, and here we are once again. We're right now between that yellow, almost between the red and yellow lines, almost down to the yellow line right there. So extreme low volume, and trading's all about probabilities. Probabilities say that sooner than later, again, this can last for a while, or sometimes it's more of a one and done. You have a brief drop down to that level, and then the correction sets in. So it's not a timing indicator. It just shows us conditions under the hood in the market. Market's drifting up on almost no volume, or meaning really low volume. Here it is on QQQ, same thing. There was our persistent extended period of low volume right there, leading up to the biggest drop in decades right there. And there was another big drop back there. you can see all the levels marked. So that's it. Just pointing out that the volumes remain very, very low, and that's part why you're seeing these whipsaws. Here's what QQQ looks like. We've had a series of these divergent highs, divergent high, little correction, divergent high, little correction, and the divergences continue to build. So at this point in time, we're not anywhere close to having these divergences taken out. If we had a big ramp into year end or a big ramp after the first of the year, maybe the divergences get taken out, but unless they do, this, meaning these negative divergences coupled with the extreme low volume, puts the odds at a sizable, a decent, meaning a tradable correction at above average, well over 50% that we're going to have that soon in the coming weeks here. Yeah, same story on IWM. Whipsaw signal. We had a nice clean uptrend line, pulsive breakdown. We back tested, but then we recovered back above the uptrend line right there. We're on it. So again, we've sliced through it, which takes away some of the validity, but there's still a lot of reactions here. So while that was definitely, at this point in time, we're going to have to consider that a whipsaw. Maybe this pop back up was also whipsaw. Maybe the next break of this line, as well as that one on the S&P 500 I started with on SPY, maybe that triggers the next drop. And if so, same targets that I've outlined now for the last few weeks. So that's it. Again, low volume leads to these whipsaw signals. It's the end of the year. A lot of year-end window dressing, position squaring, tax loss selling, things like that. So we might have to wait until after the first of the year to really get some clues as to which way this market's going to go. As of now, like I said, those sell signals from last week are called into question with the indexes snapping back above those levels, but it doesn't change the technical posture with the divergences and the extreme low volume that we've seen the market. In fact, let me look at it here on IWM. There's the line right there. So volume's not as bad as far as hitting those low extremes on IWM, but again, the market, the stock market is the S&P 500. It's much more indicative of the market. So we have SPY and QQQ again at those low volume extremes. All right, let's move on, look at a few other things, and we'll wrap this up. Let's talk on gold and the U.S. dollar. Gold, here's what it looks like on the daily chart. We're still in a downtrend since the peak back here from August. What was that? August 6th. Been walking lower. The very near-term trend is up. If we turn off all the lines, we've been moving up since this point here. So there's your very near-term trend, but this is the intermediate-term trend, still in a downtrend. And of course, the longer-term trend is bullish. So long-term trend, intermediate-term trend, and short-term trend right there. Now, what's probably the most important thing, or at least what I've been watching, is the euro and U.S. dollar. The euro-U.S. dollar pair right here. We did have a break of this trend line. It wasn't very impulsive. I talked about that, but we are below the trend line there. So that puts the euro-U.S. dollar on a in my opinion, even though the trend is bullish, meaning the euro's been going up, dollar's been going down, the trend is bullish, but the outlook is bearish. So what this would have us, if this plays out, which I still expect it will, that's going to be a drop in the euro, which means the dollar is rising against the euro is falling against the dollar, and that would certainly impact gold. So there it is. So you have your negative divergences. You have a breakdown, but we're just not going anywhere. Again, it's the end of the year. It's just like the stock market. It's kind of locked in a sideways trading range recently, not going anywhere. These sell signals that we've had haven't panned out yet, but certainly one to watch. I'm going to show you dollar futures. Okay, these are the US dollar futures DX. This is a 60-minute chart here. And what you can see is we had a downtrend line right there, very well-defined downtrend line, positive divergence, which is bullish. We had a breakout. That proved to be a whipsaw. We fell back down, or this was maybe the whipsaw. Pretty much it was a little bit of an overshoot, but since then we've been back testing the trend line. So the breakout is still intact on the dollar, but it's not going anywhere. In other words, broke out there, didn't follow through, back tested, still back testing. So this would again jive with what I was just saying on the euro US dollar pair. Should this pan out, then, and again, the charts are constructive. Should it pan out, that would lead to a rally in the dollar, which would put downward pressure on gold. So near term, we need to see this start to move up. We need to see, of course, the dollar take out that previous reaction high and then this 91-ish resistance level there. And if so, that would open the door for a bigger rally in the dollar, which would put downward pressure on gold. Longer term, I remain bullish. Just near term, I'm still cautiously bearish, let's say, on gold, cautiously bullish on the dollar. We don't have any hard buy signals here. And again, everything has been whippy. You can probably just hear it in my voice. There's just not been a lot of opportunities. Again, look at the dollar. You've gone nowhere. It's not going in the last few weeks. Not going up, not going down. We had the breakout. But no follow through yet. So that's it. Kind of watching those two. The other one of the other metals I've covered recently is copper. That's HG for copper futures. We had a breakdown there that was pretty solid. It was impulsive. We back tested and went on, hit the first target, almost hit that second target there. We've had a snapback rally. We're still below trend, so there's still a sell signal on copper, still below the trend line. This one here. But again, like everything else, not going anywhere. We've had these sell signals trigger with a lot of things, and there was certainly a little bit to be made there. But so far, we're back to about where we started, maybe even a hair above the breakdown level right there on copper. And again, if you don't trade futures, CPER is the ETN that tracks copper futures, and you can see it there clearly. There's the uptrend line, there's our breakdown candle, nice and impulsive, and so you're actually still below the breakdown level right there on copper CPER. All right, what else is there to cover? Let's see. Oh, natural gas. I want to talk on natural gas real quick, and then we'll wrap it up. Nat gas is big down in nat gas today, down over 9% right there. So you can see that we had a breakout recently above this downtrend line there. Breakout started to run up, ran into that 762 resistance level right there. That checked the rally and then started moving down impulsively lower. Now we do have some divergence setting up, potential divergence. It's not confirmed, and that's on the RSI. The PPO is actually slightly below that previous low right there. So one to watch. It's beat down. I can't make a case to step in and buy. Usually when you get this oversold, you get a nice snapback rally. So I imagine a pretty sharp snapback rally is coming. And if you do want to target this long, I wouldn't short it here. And I can't make a strong case to go long. But if you do, here's the levels to watch. I'm going to actually add that level. You have a big old gap right there. And you also have these reaction lows right there. So I'm going to put a line right here. And that's about 355. That is a key technical level to watch. Again, it's those reaction lows and the recent reaction highs. It's not a big move, but if you trade natural gas futures, it's worth it if you're going to take a shot. Again, it's almost a pot shot to step in here. It's an oversold play, and I always have to caution, oversold often does and can become more oversold. So you don't want to buy a security just because it's oversold. Just like you don't want to sell something or short it just because it's overbought. If I could make a stronger case, and I'll keep an eye on it and I'll do follow-ups, there might be a trade to be made here stepping in. But if you do take it, that would be your first resistance. If they can take that out, there's a big old gap. I mean, there's the top of the gap way up there, and there's also the trend line. So those would be your natural targets. Let me just put a line there for the around the top of the gap. Right about there. So 2511 or so would be your next stop after 355. Downtrend may come into play, and if it does, that would come in right before that 511 level. Okay, I want to wrap it up here. Just loop back to I didn't cover the futures earlier, but on the small caps, I just wanted to mention this. I showed you IWM before snapping back above the trend line. This is RTY. It's the same thing. You had a breakdown there. It looked legit. It was certainly impulsive. Hit that first support there about 1895.60 or so. Bounce from there, and there's this minor trend line right there, and that previous uptrend line. So it is possible, again, on SPY and IWM and some of these other tracking ETFs and futures, that we could break that same trend line, and that would take us down. It would open the door to move to those same targets I laid out last week. So those are the levels to watch. Again, trading's been choppy, erratic because of the low volume in large part. And again, being the end of the year, that's just kind of what you get. Usually, as I said, I often take off the end of the year from trading, whether I'm on vacation or not. This year, I happen to be around, but there just hasn't been a lot to post. So I've taken the last, since Christmas off with my family, spending time with the family. And I'll continue to post updates if I see anything that stands out. As of now, there's just not a whole lot of trading opportunities I see between now and year end. We'll wrap it up here, and if I do come across anything, I'll be sure to put a post out for you. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.